Have you ever wondered what's really driving the success behind those, super innovative home products, things like the fancy blenders or those smart vacuums that just seem to be everywhere?
Hmm.
Well, today we're going to do a deep dive into the latest results from a company right at the heart of all that.
Okay, sounds good. Which company are we looking at?
We're focusing on SharkNinja Inc., the company behind the Shark vacuums and the Ninja kitchen gadgets.
Ah, right. Big names.
Exactly. And we've got their recent Q2 2025 earnings report right here. It's packed with financial data, comments from management, and their outlook, too.
Got it. So lots to unpack.
Yeah, our mission here is to really get behind these numbers, not just what they are, but why. We want to give you a clear picture of how SharkNinja is doing and maybe what that says about the broader consumer goods market.
Makes sense. Let's get into it.
Okay, so let's start with the headlines for Q2 2025, comparing it back to Q2 2024. The big numbers are, well, pretty striking. Net sales jumped significantly. We're talking 15.7%, up to about $1.44 billion.
Wow. Okay. 15% growth is solid.
It is. And the profit side is even more dramatic. Net income basically doubled. It soared 105.1% to nearly $140 million.
That's doubled. That's huge.
Right. And adjusted EBITDA, another key profit measure, saw a really strong 33.2% increase. That's about $223 million, or 15.5% of their net sales.
So strong top-line growth, but even stronger profit growth. That's impressive.
Exactly. Even their gross margins ticked up. GAAP margin up 90 basis points, adjusted gross margin up 30 basis points.
And 90 basis points, that's almost a full percentage point improvement on margin. On over $1 billion in sales, that adds up fast.
It really does.
What's really remarkable here isn't just the growth itself, but like you said, the profitability of it. Doubling net income, that suggests they're not just pushing volume, they're operating really efficiently, or maybe they have stronger pricing power.
Good point.
Which is pretty rare in the consumer goods space right now. It's competitive out there. The CEO, Mark Brokus, he called these outstanding Q2 results and specifically mentioned they delivered them even in challenging global environments.
Ah, okay. So not just riding a wave, but actively managing well despite headwinds.
Yeah, that seems to be the implication. Strong execution.
Okay, so those headline numbers are definitely strong, but it makes you wonder, how are they actually doing it?
Right. What's the strategy?
Well, Barocas laid out this three-pillar strategy that really seems central to their success. Pillar one is expanding into totally new categories.
Okay.
He gave the example of viral successes, like that Ninja SLUshi maker.
I've seen those, yeah.
Pillar two is about gaining market share in their existing categories. So not just growing with the market, but actually taking share from competitors.
Right, becoming more dominant where they already play.
And the third pillar is accelerating their international growth, really pushing beyond their core markets.
Global ambition. So new stuff, dominating old stuff, and going global. Sounds comprehensive.
It does. From your perspective, looking at those three, which one feels like the biggest driver right now? Or are they all firing?
That's a good question. I mean, connecting this to the bigger picture, these pillars really show how SharkNinja seems to have mastered creating these, micro niche products.
Micro niche.
Yeah, they find these really specific consumer needs or desires, like wanting slushies at home, and then they just rapidly push out a product that often goes viral. Sort of bypasses the slower traditional innovation cycles you see elsewhere.
Interesting. So speed and identifying trends are key.
Exactly. It fits their whole identity as a demand creation engine, as they put it, solving specific problems with these, highly rated products. And Baroque has also stressed their comprehensive supply chain diversification.
Ah, the operational side.
Right. He said strengthen their competitive position. Kind of makes you wonder how much of this success is pure product genius versus just really, really good operations and supply chain management, allowing them to capitalize quickly.
It's probably a mix, right? You need both.
Seems like it here. The operational strength lets them actually deliver on those quick product wins.
Okay, so let's dig into that 15.7% sales growth a bit more. Where did it actually come from? Category by category, region by region.
Yeah, let's break it down.
The really big winner this quarter was food preparation appliances, a massive 52.8% increase.
The fee 2.8, wow.
Yeah, up to about $405 million. And the report says this was mainly driven by, you guessed it, the frozen drink stuff, specifically the SLU Shy and also ice cream makers.
Okay, so those viral hits are really moving the needle.
Definitely seems like it. Other areas did well too. Beauty and home environment was up 25%.
Quarter of growth there. Nice.
Yeah. Yeah, about 173 million. That was thanks to things like their FlexBreeze fans, air purifiers, and also a new product launch in 2025, these CryoGlow face masks.
Interesting. Branching into beauty tech more.
And cleaning appliances, sort of their traditional Shark territory, was up a healthy 7.6% to over 500 million, boosted by carpet extractors and robotics. Robot vacuums, presumably.
Okay, so solid growth even in their established categories.
But there was one surprising dip. Cooking and beverage appliances actually decreased 3.6%.
Oh, like what?
Down to about 366 million. The report says it was mainly a decline in air fryers and outdoor grills.
Air fryers may be cooling off a bit after the huge boom.
Could be. Though they did say it was partly offset by momentum from their Ninja Luxe Cafe espresso machine, so shifts within the category.
Right, consumer tastes moving around.
And geographically, domestic sales up a solid 13.7%, but international grew even faster, 20.3%.
Okay, so that international push seems to be paying off quite well.
Yeah.
This breakdown is pretty revealing. The huge growth in food prep and the strong showing in beauty and home environment, it really suggests they've got their finger on the pulse of what consumers want right now.
Like capturing those trends.
Exactly. The SLU, she's the perfect example, hitting that trend at just the right moment.
But the slight dip in cooking and beverage, even for a powerhouse like Ninja, just highlights how dynamic things are.
Yeah, nothing stays hot forever without some reinvention.
Right. What's a must-have one year might need a refresh or face new competition the next. It's a constant battle.
Okay, so that brings us to sort of the nuts and bolts. Financial efficiency. How do they manage costs and margins while getting all this growth?
Yeah, the profitability side.
Well, gross profit was up 17.9%, hitting $708 million. And those margin improvements we mentioned, the 49.0% gross margin at 49.4% adjusted gross margin, they said that was mainly driven by cost optimization efforts. But also, significantly, a decline in the fees they were paying JS Global for supply chain services. That separation paying off on the bottom line.
Seems like it, though they did note it was partially offset by tariffs. Now, here's something interesting. R&D expenses actually decreased slightly, down 0.7% to about 89 million.
Decreased, even while launching new stuff.
Yeah, even though they added headcount for new categories and markets, which added almost 9 million in personnel costs. The report says the overall decrease came from lower spending on consultants, prototypes, and consumer insight work.
Okay, so maybe becoming more efficient in R&D.
Perhaps. But contrast that with sales and marketing expenses. Those increased 18%, up to about 358 million.
Okay, that makes sense. Pushing the new products.
Right. More personnel for launches and expansion, higher delivery costs for their direct-to-consumer site, and just more advertising spend.
Supporting the growth.
And one more. General and administrative, or G&A, expenses also decreased, down 11% to 92 million, mostly from lower legal and consulting fees.
So trimming some overhead costs too. What does this mix tell you? R&D slightly down, S&M way up.
Yeah, what's the takeaway there?
Well, it's a fascinating picture, isn't it? Optimizing R&D spend while significantly ramping up sales and marketing suggests a really strategic focus.
How so?
It could mean they're maybe leveraging existing tech platforms more effectively, focusing R&D on, say, faster iterations or line extensions, rather than pouring money into brand new high-cost fundamental research right this minute.
Okay, getting more bang for their R&D buck, potentially.
Potentially. And that allows them to shift resources to really pushing those products into the market, supporting the launches, driving awareness, expanding geographically. It looks like a conscious choice to prioritize market penetration right now.
And that reduction in sourcing fees post-JS global separation clearly helps fund some of that, or at least boosts the margin.
Absolutely. That's a direct financial benefit hitting the bottom line. It really shows them fine-tuning the whole operational and financial structure to maximize profit from their sales engine.
Okay, so this all flows into their overall financial health and what they're expecting for the rest of the year. Let's look at the balance sheet and outlook.
Right, the forward view.
As of the end of Q2, they had about 188 million in cash. Total debt stood at roughly 760 million.
Okay, so some debt, but manageable cash.
Inventories, though, were up quite a bit, 25.2% increase to just over $1 billion.
Over $1 billion in inventory. That's notable.
It is. But here's the big news. They raised their guidance for the full fiscal year 2025.
Oh, they upped the forecast.
Yep. They now expect net sales to increase 13 to 15% for the year. That's up from their previous range of 11 to 13%.
Okay, so expecting this strong momentum to continue.
Seems so. Adjusted net income per share is now projected between $5 and $5.10. That's up from $4.90 to $5 previously.
Another solid bump.
And adjusted EBITDA outlook is also up, now $1.1 billion to $1.12 billion, compared to $1.09 to $1.11 billion before.
So across the board, raising expectations.
Pretty much. They're also planning capital expenditures between 180 and 200 million, mostly going towards investments in new product launches and technology.
Which ties back to that innovation engine. So what's the significance of raising guidance like this, especially given the, challenging global environment they mentioned?
Yeah, what does that signal?
Well, raising guidance, especially now, signals really strong confidence for management. They clearly believe in their, what they call, proven playbook, robust innovation pipeline, and relentless execution.
It's more than just meeting expectations. It's signaling they expect to beat prior forecasts.
Exactly. Now, that inventory increase, it's definitely something to keep an eye on. It's a big jump.
Right, over 25%.
But if it's tied to the strong demand they're seeing, and, importantly, those upcoming product launches they're investing in,
then it could be strategic.
It could be a sign of preparing for expected demand, rather than a sign of unsold goods piling up. A calculated risk, perhaps.
Yeah, that makes sense. For a company built on speed and hitting trends, maybe having the stock ready is crucial. You don't want to launch a viral hit and then run out immediately.
Precisely. It's a balancing act, but the raised guidance suggests they're betting on continued demand.
So, looking at all this, the strong sales, the even stronger profits, the strategy, the outlook, what are the key takeaways for someone watching this space?
Well, before we get to the big picture, maybe we should quickly touch on those non-GAAP terms we've been using.
Oh, good point. Yeah, you see things like adjusted net income and adjusted EBITDA all the time in these reports. We should clarify why companies use them.
Exactly. So companies use these non-GAAP or adjusted metrics to try and give what they argue is a clearer view of their ongoing core operations.
Stripping out certain items, right?
Right. They often exclude things that might be seen as one-offs or non-cash expenses, stuff like share-based compensation, maybe litigation costs, foreign currency swings, amortization of certain intangible assets from acquisitions.
Things that don't reflect the day-to-day running of the business.
That's the idea. In SharkNinja's case, they also specifically called out excluding a product procurement adjustment and the impact from a voluntary product recall in their adjusted numbers for this period.
Okay.
The point is to help investors and management themselves sort of better evaluate the financial performance compared to other periods or even other companies by focusing on the underlying business trends.
So seeing the core operational results without the noise of unusual items.
Yeah, basically trying to get a more apples-to-apples comparison of the core business over time. It's important to know what's being adjusted out, but it can provide useful context.
Okay, good clarification. So let's zoom back out. We've really dug into SharkNinja's Q2. Impressive numbers, clear strategy, detailed category performance, some smart expense management, and a pretty confident outlook for 2025.
Yeah, a strong quarter by almost any measure.
What this whole deep dive seems to reveal is a company that's gotten very good at turning that product innovation into, well, actual financial results, even when the broader economy might be tricky.
They seem very adept at navigating the current landscape.
It does make you wonder, though, in a world where consumer tastes change so fast and tech keeps advancing, how long can a company keep riding that wave of viral successes like the Ninja SLU?
That's the million-dollar question, isn't it? Sustainability.
Yeah. What's the ultimate secret to keeping that demand creation engine running hot year after year? Something to think about.